Welcome to Lesson 8 of Federal Taxation Class Number 3. Today is our last meeting, and we cover a number of interesting subjects here, and I will have to read you some page numbers that you currently don't have. After completing this lesson, our objectives are: number 1, to understand IRS assessment rules; number 2, to recognize the IRS payment procedures; thirdly, to understand the statute of limitations; and last of all, to describe the rules to impose penalties to tax preparers. The reading assignment includes limited liability partnerships on page 88 on business law. We don't actually have that page, but we do have approximately page 53, I believe it is, not even that high. Page 30, you will find in the tax book, online book, material on that. We'll take a look at that in class. Read corporations on business law, and of course watch this video. The the discussion questions we'll cover next, and then we'll go to the text which explains them. Question number 1, discuss the statute of limitations of IRS assessments. Some things have a limit, that is, they have to be addressed within a certain length of time or they go away. Other things never go away, and fraud is one of those. Discuss the rule to claims for tax refunds, number 2. Number 3, discuss tax preparers' liabilities and providing tax services. If you're doing tax services, this is most important that you understand what your liabilities are. And finally, discuss the penalties that may be imposed by the IRS on the tax preparer themselves. Let's take a look at Schedule of Limitations. This is found on page 28 of Federal Taxation Number 3, textbook, online textbook, page 26. The statute of limitations IRS may impose additional tax liabilities against taxpayers within 3 years of their filing an income tax return. What this amounts to is you have 3 years in which you have to keep track of your records, and at the end of that time, the IRS cannot come after you for more money, and you are able to dispose of your records after 3 years. The requests for refunds are governed by the same limitation. They must be filed within 7 years from the date of return if the refund claim is to the time the claim was due. Corrections of taxpayer returns. The taxpayer generally has forgotten to report some income. These deductions or credits should not have been claimed. Also, the taxpayer did not claim a deduction that could have been claimed, or the taxpayer should have filed a different filing status. All of these are corrections, and again must be filed within the statute of limitations. Moving on to the taxpayer's penalties. The page 27 of the text covers 2 issues: penalties and estimated payments. Penalties: taxpayer fails to file a tax return by the due date. The penalty is 5% per month, up to a maximum of 25% on the amount due. There is no penalty due under any circumstances if the taxpayer's tax due at filing is less than $1,000 for the individual, 500 or more for the corporation. Taxpayer fails to pay a tax due amount. They make an estimated tax payment, and this is due on April 15th, June 15th, September 15th, and January 15th. The estimated tax payments are required if a tax liability is expected to be at least $1,000 a year from 1998. And estimated payments 90% of the current year, 90% of the annual current year, 100% of the prior year, and 110% of the prior year rule only. So we'll take a look at those in class. Taxpayer liabilities. The preparer liability includes signing the tax return. A federal ID number and address should be added to the tax return for the preparer themselves, and a copy of the tax return is required keeping for 3 years. The preparer has to do that as well as the taxpayer. When preparing the return, the preparer depends on accurate information supplied by the taxpayer. If the taxpayer provides inaccurate information, or the taxpayer, the preparer is not responsible for that. They're not required to obtain supporting documentation unless there is some reason to suspect the accuracy of the information. If the preparer fails to make inquiries when the taxpayer's information appears incorrect, the preparer can be subject to a penalty. If errors are found on the previous returns, the CPA must inform the taxpayer of those errors, but the preparer is not obligated to correct the errors, merely to point them out. Of course, they can correct them for money, for a fee. When recommending a position, the CPA should recommend a position only if there is a realistic possibility of being sustained, of that petition being sustained. If challenged, where there is conflict, the IRS will issue a letter. The taxpayer should pay the amount the IRS assessed or request a conference or wait for the 90-day letter and file a specific petition with the tax court. Finally, page 29, continuing the issue of penalties. We have accuracy related penalties, and there are 2 of those: negligence penalties, intentional disregard, wrongful or unauthorized disclosure, and a number of other minor penalties. So we will take a look at those in class, and that will comprise the lesson and prepare you for the discussion questions. Keep in mind the final exam is lengthy, and you should allocate plenty of time where you won't be interrupted in order to take that test with a reasonable chance of passing it with a high enough grade to earn an A or a B in this class. That's what we're after. It's been a real pleasure. Look forward to seeing those of you that attend tonight. And this will be, again, our last meeting of the term. Starting next week, we will begin fall session term number 2.